What exactly happened?
Well, as you mentioned, tech really has been on a tear this year. Depending on how you look at it, tech stocks in the S&P 500 or if you look at the NASDAQ 100, either way, up more than 20% coming into today. And if you overlay on that this notion of how popular factor investing has become among the quants on Wall Street. In other words, investors look for stocks with certain attributes, whether it be high sales growth, good valuations, momentum, that sort of thing. And tech this year has really been ticking off a lot of factor boxes. Obviously, growth. Many tech stocks are still considered growth stocks. Momentum, stocks that have a lot of momentum behind them. And even low volatility. Tech stocks have become very low, not very volatile compared to how they were in the past. And this morning, Goldman Sachs had a note out basically discussing all these issues and saying, look, there's risks here. They used a word that people hate to hear in investing, and that's crowded trade. They're saying a lot of funds are overweight these stocks, and tech has, because of these gains, has become just a massive part of the stock market. Almost a quarter of the S&P 500 is tech now. So for a mutual fund manager to be overweight tech means, you hold even more than that in your fund. So there's risks there. And one of the ones that Goldman Sachs pointed out is that, look, tech is not. It's sort of odd that tech is now considered a low volatility sector. Yeah, obviously, Amazon is an incredibly volatile stock. And they said that there's risks here of this overcrowded trade. And that's a word people just do not want to hear on Wall Street. You do not want to be in a crowded trade because when it unwinds, it tends to be sort of fast and furious like we saw today.